global recession has been over now for almost 2 years, but the recovery has been tepid in many ways. And the big issues in our minds for boards and for companies is whether or not this recovery is going to be sustainable and durable. We've had a bit of a recovery, but we've already had at least one false dawn. And most of the companies we talk to are trying to answer one question. Is this recovery now for real? Does it have legs? That's the big issue for the United States and for Europe in particular. Interestingly, for the emerging markets, which are very important to companies, the question is a bit different. They've done very well. They are, in fact, in some cases, almost overheating. So we have an issue for the emerging markets of trying to slow growth, but for the United States and Europe in particular, can they reach that sustainable level where profits, where consumer spending are at a solid, reliable level? We're fairly optimistic. We feel that for a variety of reasons, in particular because of pent-up demand from consumers, because of strong business profitability, we think that while we will not unfortunately be enjoying another boom, we do think that the foundations are there for a good, sustainable recovery. The issue is that there are a number of risks to this. One of the issues we learned from talking to boards previously is that many companies had not looked at scenarios or risks as carefully as they should have and felt that they were perhaps blindsided. So what we're beginning to see right now is companies looking at a wider range of risks. What we're also looking at and also noticing is that as companies pull out of this recession, they have a few priorities. And one of those priorities has been software, IT, and capital spending. That has been a leading push out of the recession. We see from our perspective 5 potential risks. These are not our mainline forecasts, but for any board that wants to avoid the surprises, the kind of surprises we were all caught with in 2008 or 9, here are 5 things to keep an eye on. One, and very important right now, is inflation and rising prices. For any company right now that's buying raw materials, or for that matter, for companies that are buying almost anything, energy purchases right now, you're seeing inflation rise very, very sharply, and that hits consumers. If you're in a consumer-oriented business right now, you're worried about inflation. That's number one. Number two, borrowing costs have been pretty low. Companies that have had good credit have been able to borrow. But now you're beginning to see central banks, after this period of easy money, almost free money, beginning to raise interest rates. This has happened in Europe. It's happening in many emerging markets. Probably won't happen in the United States until next year, but certainly interest rates could be an issue. A third one, and this is just as important as if you're in the United States or if you're overseas, is China. China is the biggest contributor to global growth these days. And remember that even for U.S. companies, a large portion of their profits now come from overseas. China is an issue because China is overheating. China is trying very hard to take some of the steam out of its economy, but it's going to be a very delicate balancing act. If China pushes down too hard, if they put the brakes on too hard, and China's economy were to crash, that would be felt globally. China is big enough now to have a ripple impact, a substantial ripple impact across the world. A fourth issue, if you're based in Europe, if you're selling in Europe, you know what's happened with the Eurozone. You know that there are already 3 countries that have essentially had to be bailed out. There may be others coming on stream as well. The Eurozone, in our view, will survive, but there's a great deal of austerity in Europe these days, and it will be a difficult pull for Europe over the next couple of years to maintain the kind of growth they want. If you're a U.S. company relying on profitability from your operations in Europe, there's at least a risk that those might be softer than you're anticipating. And then finally, we had a big asset bubble in 2005 and 6 and 7 that led to the recession. There's some indication that we might be going through that again now. Look at stock markets in many countries. Look at currencies. Look at commodities prices. There's an indication again that all of this free money right now might be pumping that bubble back up again. So those are 5 issues that we've looked at: inflation, borrowing costs, a possible crash in China, issues with the Eurozone, and then an asset bubble. None of those form our main scenarios, but if you want to be aware of what's on the horizon, keep an eye on all 5 of those. One of the defining features of the global economy not just over the last few years, but even over the last 20 or 30 years, has been a series of factors that have led to unprecedented uncertainty, volatility, ambiguity, and complexity. Those are four particular elements of this. If you look back over the last 50 years, we have had a more disruptive global economy over the last 10 or 20 years than we had previously. Money is flowing in and out of countries for a variety of reasons at phenomenally fast paces, which has really disrupted business. As a result of this, what we have found in talking to boards, especially coming out of this very, very deep recession, but really we've heard this even going back before that, they want to look at a wider range of scenarios. Going to boards with just your baseline scenario is not enough. Clearly, boards want to know what management thinks and what management expects, but they also want to know at least 2 or 3 downside scenarios and possibly 2 or 3 upside scenarios. No one wants to be caught as unprepared as most companies were in the 2008 and 2009 recession.